Let's bring in somebody who's quite familiar with the company. Brendan Ahern is KraneShares ETF's Chief Investment Officer. Brendan, a lot to get through to on this one. Chinese tech companies certainly under a lot of scrutiny, as I just said, but how are you looking at this particular listing? How significant do you think the appetite's going to be?
Well, I think you made a great point, Akika, where the company did price the shares to move. And so ultimately, you have a company that is very large and growing very rapidly. This company did $6 billion of revenue in the first quarter of this year. That's revenue growth of over 90%. Each of the last 3 years, Didi has done almost 100% revenue growth. And so by pricing at the top of the range at $14, this is too good of a deal for investors to pass on. We don't know the extent oversubscribed, but it sounds like pretty significantly.
Yeah, and Brendan, the other thing too, I mean, it'd be simplistic to maybe say what we got here, Didi's just Chinese Uber. But I mean, when you look at kind of how they're looking to grow the business, I don't know if that's necessarily a fair comparison. I mean, when you compare it with Uber, what stands out as maybe key differentiators that investors should be aware of?
Well, one is just this company is growing much, much faster than Uber. So yes, the core business looks like Uber, taxi cab hailing, car service hailing. At the same time, Didi has a very clear vision of where they believe the world is going. And that's first an adoption of EV. So they want to move their fleet to electric vehicles. And the second is going to be autonomous driving. And I think they envision the world where their autonomously driven EVs come out from the proverbial suburbs into Chinese cities and then go home each night. And that's a world that they see evolving in China and that they want to capitalize globally to the point you made, Zach.
Brendan, I have to say, I read that and thought, that sounds a lot like what Uber was saying several years ago when they were really betting big on the autonomous vehicle side, which they've since sort of pulled back from. How do you think Didi's vision is different than what we've heard from these other ride-hailing companies who've essentially, when they came to market, said, look, our path to profitability runs through autonomous driving?
I think it's a great point. Uber talked this game and then they ended up basically selling their autonomous driving unit. Didi, on the other hand, has committed significant capital and resources to make this vision come to fruition. They're doing beta testings in Chinese cities today with these autonomously driven taxis. So it's happening. I think that's the difference that in China, they're actually doing this. It's not something that's on a whiteboard. It's happening. And I think that's one of the ways that this company can get to profitability.
Yeah, what do you make of maybe the pricing that we're seeing here? Of course, you were talking about the green shoe and options here to maybe bring in a little bit more. But when you think about kind of how this is falling at a time where maybe some of the excitement isn't there around some of the IPOs in general, writ large, but then also around ride sharing right now, it's just kind of one of those areas I think where maybe investors are seeing what's coming in terms of the enthusiasm as we reopen here relative to the pandemic. Pretty easy to show growth off of what we saw last year. I mean, what do you make of the excitement around it now, and maybe how it could have been a little bit higher?
Yeah, I mean, I think the U.S. listed China space, KWEB, our KraneShares CSI China Internet ETF, almost a $5 billion ETF invested in U.S. and Hong Kong listed companies is off. Now, I think to some degree, we've had everything but the kitchen sink thrown at the space. You have U.S. regulation, you have China regulation. 5 of the 10 stocks held by Archegos were U.S. listed Chinese companies. And then you have this backdrop of value versus growth, that investors globally have been overweight growth companies, tech, FANG, and the commodity rally, high energy prices has created a value cyclical. So you're seeing a rebalance. So net, the names that we hold in KWEB are very, very inexpensive on a historical basis. We're below our 5-year historical PE ratio, the same on a forward looking. On a relative basis to US tech, US internet, these Chinese names are very, very inexpensive. And I think that's why we're seeing inflows into KWEB and into the space.
Really quickly, Brendan, how do you think investors should be looking at the regulatory overhang here over in China, but also in the U.S. right now, the threat to delisting some of these Chinese companies? How should they be looking at that in the context of Didi? But also, why do you think we've continued to see Chinese companies come to the U.S. to raise capital despite that?
Yeah, I mean, the Chinese regulation is happening. These companies haven't played nice with one another in the proverbial sandbox, and that's going away. It's important when we look at Q1 2021 earnings for the KWEB companies, they're tremendously strong. So despite these regulations, the companies are still doing well. They're very, very critical parts of the domestic consumption story. 30% of all retail sales happens in China. On the US regulation, I do think it's important that we have Gary Gensler, the new chair. He just removed the previous administration's head of the PCAOB, who wasn't going to solve this issue. So I think there's an opportunity to solve this issue. A delisting would take many, many years to come. And I think you're seeing Chinese coming like Didi, coming to the New York Stock Exchange because they don't believe the delisting will ever happen.